been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is multifamily investor and syndicator, Spencer Cullor. Now, Spencer holds expertise in commercial, multifamily, and residential real estate. He also spent several years as a home builder before moving over to the investment side. Using his skills in project management, capital raising, financial analysis, construction, and contract management, he has successfully owned and managed multiple framing crews, has overseen numerous rehabilitations and flips of residential homes, multifamily properties, and started his own property management company specializing in multifamily and commercial properties. So, guys, I'm excited to have Spencer back on the show here for a second time to find out what he's been up to since we last spoke back in 2015. So I thought it was like 3 years, and I look back and it was like 5. So lots can change. A lifetime of change can happen in 5 years. And so I'm excited to have him back here. But before we get on to it with Spencer, just have a few quick laundry list items to get through. First and foremost, our third mobile home park investment fund recently went live. If you'd like to learn more about partnering with me and my team on future opportunities, you can go over to investwithsunrise.com. Again, that's investwithsunrise.com. There you can watch our most recent webinars and access our PPM and offering docs. And you can also learn why we feel mobile home parks are one of the best investment vehicles to date. Okay, we've got a lot of information there on that website. And you'll also learn why some of the biggest private equity firms are pouring billions of dollars into the space just over the last couple of years. Everyone's hot and heavy on mobile home parks. And so if you'd like to get into the space, but not really looking to get into it actively and would like to team up with partner up with a team that's been doing it for nearly a decade now, again, go over to investwithsunrise.com to learn more. Moving on here, if you love what we're doing at the Real Estate Investing for Cash Flow podcast, then take a moment, subscribe to the show if you haven't done so. That way you get notified when all new episodes come out. Additionally, if you feel like we add value to your business each and every week, then take a moment, go over to either iTunes or Stitcher Radio or wherever you might be listening to the show and leave a rating and review. It really allows us to attract awesome guests such as Spencer to the show. And then lastly here, I want to remind you of the free 30-minute phone call I offer each and every Friday afternoon. This is where I set aside 3 30-minute time slots to connect with you, the listener, okay? I've been doing this now since I basically started the podcast, and it's a way for me to really just, share my passion with others that have that same passion for real estate investing. It doesn't matter whether you're brand new or a seasoned pro. I'd love the opportunity to connect with you. I've spoken to hundreds of you over the years now. If you'd like to schedule that call with me, you can go to my website, kevinbupp.com, to schedule a time to get together. Now, guys, without further ado, I'd like to welcome back Spencer Cullor. Spencer, how you doing today?
Good. How are you?
Doing great, man.
Talk to you.
Yeah, absolutely. Excited to have you back here. Again, lots changes. A lot can change over 5 years. And I was a little surprised when I looked at the date of our last recording. Again, I thought it was like 2 or 3 years ago. It was 5. So 2015. This past year has been crazy enough in and of itself. And now we're talking about 5 years. So lots can go on over a 5-year span of time. And so, I'm excited to dive into that, Spencer, and learn, really what you've been up to over these last 5 years. But before we do it, maybe for the folks that aren't familiar with you and your background, your story, maybe take a few moments and just expand a little bit on that bio I gave you. Tell us a little bit about yourself, your background, how you found yourself into real estate, and then we'll dive into the nitty gritty of what you're up to today.
Sure. Well, we're a privately owned family real estate investment company. We did start doing syndications about 5 years or so ago to add investors into our deal, but it originally started, I was working a full-time corporate job, started doing real estate investing things on the side, grew that into my main business, left the corporate world, and kind of haven't looked back. We've done residential home building, retail properties. Then we went into multifamily. And since we've started in multifamily, we've really taken our whole focus down that lane and put on blinders and gone forward. We kind of specialize in that underperforming property, coming in, doing a lot of capital improvements to the property, improving the operations, and then we either hold them long term or we flip them.
Got it. What was your corporate background? What did you do?
I actually worked for a software company and I did sales and marketing.
Okay. That's a very different world than real estate investing.
Yeah.
What were some of the skill sets that you felt really carried over and complemented the real estate investing side?
Well, a lot of my background is in construction. I grew up in a family business where we did ready-mix concrete plants, and I was always around construction projects. So that kind of led my way into it. I like technology a lot, so I, in college and outside of college, got into technology, and that's where I found a software company that I worked for about 7 years, and grew that business. But my passion was always being an entrepreneur in real estate, and I like to build and construct things, make things better. So that kind of fit better with what I was doing, but I've been able to really leverage my technology background and my marketing background in the real estate world.
Mm-hmm. Great. And you had mentioned that you obviously you're a home builder. You guys invested in residential properties, retail properties, other types of commercial, but ultimately found your way to multifamily, and then really decided like that was the path that you were going to focus on. What were some of the big reasons why you decided to pull the folks away from maybe some of those like the retail assets or the single family assets?
Single family, it was. Every time you built a home, you kind of had to wait till the very end to find out if you were going to make any money. So timing had a lot to do with it. And every time you sold a home, you were out of business until you had another one pulled up. So really what got us at, I liked that aspect because there was a lot of reward to it with building it from scratch and getting to see this awesome house be created. Things that we didn't like so much as you had to sit and wait, and the market could change a lot in that 9 months that it took you to build a house. And so we were doing a lot of spec homes. Luckily, the market started to slow down, but we kind of saw it slowing down, sold our inventory before the market crashed. In that, we started looking for something that was more cash flow oriented. And that's where we got into more commercial properties, started in the retail side. I can tell you the things I don't like about retail and I'm glad we sold those properties now and are out of the retail space. The things I did like was that it could produce pretty good cash flow. It was pretty stable. You had more long-term contracts there with tenants. The things I didn't like about it is if you had a tenant leave, it could take a year to replace them. And the tenant improvement dollars you had to put in to replace them might be $100,000 on one tenant. Also, the value fluctuations for one tenant can mean $1 million difference in your business, or $10,000 positive on the cash flow or $10,000 negative. So it was a little too wild for me. The unpredictability, like instead of worrying about tenants and if they're keeping their jobs and paying the rent, we were worried about businesses and if they were able to stay in business or do this or get replaced by technology, or there were a multitude of different things. And it's such a different, even though it's a cash flow generating business, it's so much different than multifamily. And it so much has to do with if you're on the right side of the street when people are going home from work versus coming in, or the egress that you had on your buildings and traffic flows. And so,
now it's like is the business that's in my retail center, is it e-commerce proof? That's really it. Like that's the question. Is it e-commerce proof? Not just today. Is it e-commerce proof 5 years and 10 years down the road? Mm-hmm. And if it's not, then there's truly a significant risk there. And I think also, You can correct me if I'm wrong, but typically now, I mean, there are instances where, you're going to have a vacancy, companies going out of business or moving to a bigger location, what have you, and you've already got someone lined up to come in there, right? In the perfect world, that's how it goes. But a lot of times when a unit goes dark, it typically is dark for a, much longer than that of an average, vacancy in your multifamily property, whereas in your multifamily property might be down for 30 to maybe 45 days, maybe 60 at the most, hopefully no longer than that. But in a retail, I mean, it could be months or sometimes even years, which, could absolutely crush your cash flow and, again, the value of that property. So no, absolutely. And now during the pandemic, I know that, retail, certain types of retail that were already being affected, it just, was accelerated due to the pandemic. There's other service oriented retail with, grocers and neighborhood type retail services that are, I guess, at least today, e-commerce safe, salons and barbershops and nail salons and dry cleaners and things like that until drones can figure out how to come and cut your hair at your house, which would be pretty cool, or do your nails. I think that they'll be fairly safe. But, if you didn't have those types of tenants, or actually, even if you did, depending on what state you're in, a lot of states were shut down. Those businesses are still struggling. So, no, I got you. And I've actually had investments in retail. I do not today at present time, but it's one that I don't think that I will be pursuing anytime in the near future, and I'm okay with that.
Yeah, I would just say if you're going to do that, I know a lot of people that have done really well in that side. You just have to really understand the business well and what you're getting into. And when we first started, we just didn't know as much as we know now, and so that there's a steep learning curve. I think
housing is just easier to understand, right? There's an inherent need for a roof over your head. Like it's just as simple as that. And then really the only other big factor that you have to fully comprehend is, not the market itself, but really any supply demand imbalance within that specific marketplace, right? I mean, and today, I don't think there's many markets that have an oversupply, but really, that becomes the other big concern at some point during the real estate cycle is, oversupply, and then which end of that equation are you on, right? Are you having to give concessions and decrease rents, what have you? But really, at the end of the day, those are really the biggest risk. If you are doing doing your due diligence appropriately, you shouldn't even be overly concerned about that at this point.
Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche, and that's the phenomenal niche of mobile home park investing. Now, for those that don't know, I've been a full-time real estate investor for more than 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in Growth and Income Fund 3. When you invest in our fund, you get immediate diversification into multiple deals we acquired off-market that are already performing and have built-in sweat equity. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please visit us at investwithsunrise.com and request access to the investor presentation. It's absolutely free, and you'll get instant access to review the off-market deals that we've already purchased that you can co-own with our team. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-227-4359. And our investor relations team will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule the call, and let's jump on the phone. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show.
Have you guys ever considered, being that you've got a home builder background, have you ever considered the build to rent business model, subdivisions build to rent, which has now become its own asset class?
We have considered that, and we're starting to get a little more into the development side, but I think we'll probably go more towards the multifamily development.
Traditional multifamily. Yeah. Got it. So talk to me about your property management business. Before we started recording, I had asked the question of, had you ever used a third-party management company? And you had answered yes. And then, the follow-up to that is, what was the actual catalyst to building out an internal vertically integrated property management company? Because at the end of the day, this is why I tell folks, especially about the mobile home park space, there's not really too many options to have a third-party management company in the mobile home park space. And so if you're going to get into this business, then you pretty much have to already be comfortable with the idea that you're not just building an investment business, you're also building a property management company, and they're two very different things, two very different businesses. And so in the multifamily space, you'll find that the majority of the syndicators typically utilize third-party management and don't go vertically integrated. So I'd love to hear the reasons why you guys decided to take that path.
Sure. And I think there's some really good property management companies out there. But what we found was, especially when we were first getting started, we were having a lot of smaller properties. Smaller, I'm considering under 100 units. And to me, those are really difficult for a third-party property management company to manage effectively. They just have a lot more complexity when it comes to using resources back and forth, their payroll, some of the costs that you have to really keep a much closer eye on when you've got a smaller property. You just don't have enough income to cover a much higher payroll, and so you share resources across multiple properties. And we never could find a really good third-party property management company that could manage the smaller properties. So after going through a few, we decided if we're going to do this, we're going to do it our way. We like having the control of the properties so that we know every aspect of what's going on the different properties we have. And nobody cares about your property more than you do. Mm-hmm. So we figured with our background in construction and repairs and maintenance and those things, that it was a good fit for us. Especially, we general contractor of capital improvements as well. And so we can come in and we can do capital improvements on a property for much cheaper than other people can. We can typically manage it for much cheaper than other people can. And we can really control costs. So it's been a good plan for us and our investors on, we feel that's how we add the most value to a property.
Got it. And how large were you? How many units did you have under ownership when you made that transition to building it in-house?
We did it on our first property.
Oh, you did? Okay.
Family.
Well, that makes it a little easier. So you're able to actually evolve and grow your staff as you needed to hire.
Yeah. I mean, we tried third-party management on a retail property we had and on a multifamily property that we had. We didn't feel like either one really was doing a very good job. And so that's when we stepped in and I decided that I would take the leap from the corporate world over and do it full time. And it was another way that it could help pay me while we were ramping up. Got it.
Do you think there's any cons or downsides to having your own vertically integrated property management versus outsourcing to some of the better third party managers?
Sure. There's definitely some downside. It can take away focus from your core business. It can take away focus from growth. It probably slowed down some of our growth at first because we weren't. When you're focusing on your property management business, you're typically not focusing on going out and finding new properties or new opportunities or putting together new investor groups to go out and buy a property. So it really comes down to where you want to focus.
How many units does your group have today, approximately?
It's right about 1,000.
About 1,000, okay. Yeah. And then what does your property management staff look like, if you don't mind me asking? I guess not the leasing agents per se or any like on-site office managers, but like what does that look like on the corporate side of things for the property management team? Just to give a lot of folks that listen to the show, they might already be in growth mode. They might have a portfolio the same size as yours, maybe even larger, but there's plenty that are maybe they own a few smaller multifamily assets and they're kind of doing it themselves and they're trying to figure out which path to take. And I don't, adding context to what a property management company really looks like to manage 1,000 units, I think is very helpful.
Yeah, we really have a VP of property management that takes care of a lot of the day-to-day operations now. And then we have property managers on the different properties and then their staffs.
Got it. So really, on the corporate side, one very skilled, VP or whatever you want to call individual, basically the director of property, whatever that their title might be. But they're the, they're the executive staff on the property management side, and then you've got the on-site staff. At what point in time does that what size do you feel that internal staff would have to grow? Like, when does the bandwidth become so stretched with that VP that you need to add another layer in-house?
I think that can depend. I think it depends on how big the individual properties are. The smaller properties take a lot more oversight from like a regional manager or VP, in my opinion. So if you have, you can have 1,000 units over 3 properties, and I'm not sure, one regional can easily take care of that. You could have 6 properties, I think is a pretty good range for a regional manager.
And so you've got your in-house and then you got one regional out in the field. Is that correct?
Mm-hmm.
Okay.
Yes.
Okay. Got it.
Yeah. I think about 6 properties is where I would draw the line probably.
But then you don't handle the, I'm guessing then the construction side of things when you guys are doing capital improvements, that's actually, you've got someone more than likely that's running out of your investment side of the business, right? That's not built into the property management side, correct?
We do a little of both.
Okay.
Yeah, we've fortunately got somebody very skilled in that VP of property management side.
Okay.
That also has a really good background in construction.
Wow.
Which is pretty unusual.
Yeah, I'd say so.
Yeah. So, and with our construction background, I think that helps. So we kind of team up on that. So I'm not sure our organization would be typical of most other people that are doing this. They probably have a little more overhead in there.
Yeah, no, fantastic. And then, as far as that one individual, we've got a slightly larger internal property management staff. However, we do have one director of operations. He's the equivalent, probably your VP. And then we've got, tons of different field folks. One of the, what I perceive to be risk, which we've got, redundancies built in place and things of that nature, is that we're not large enough to have, another one of him or someone that has equal skill sets other than myself and my partner, which, as you had mentioned, that's one of the risks, is that you lose focus on your investment side if something happens on the property management side. And so our concern at our size, as we grow, until we can add another layer of him, of, director of operations or someone that is close to that level that could step in, is if something happened to him, right? Like, what do you do? And so what type of redundancies have you guys built into your property management model to where, should something happen to that VP, that your whole show doesn't stop? Or, Spencer and the team over here has got to come over and cover bases for a period of time until you can find someone to fill that hole.
Yeah, we're really doing two things to kind of address that. One, we're trying to put some real systems in place and documented processes and systems so that we're using our property managers to train to be eventually regional managers. And so we're trying to grow internally. At the same time, we're reconfiguring some of our portfolios. So we're shedding some of our smaller properties and replacing them with bigger properties, where we can have stronger staffs that then can grow to more regional managers. But it is kind of that there's a happy place in there, and there is risk while you're growing that. To have to replace somebody like that would be really difficult at this point, where if we can grow fast enough, we'll have redundancy in that position eventually.
Got it. I know before we started recording here, we were talking a little bit about the pandemic and just how things have been going with you guys in the markets that you're in, and as far as collections. And I know you had mentioned, and we've experienced the same thing, that, some of our properties are doing way better than others and what have you. And I was hoping that maybe we could talk about that a little bit. And have you identified maybe what differences or what separates one property that might be doing better than the next property that is not doing as well as far as collections are concerned? What are the big key components there, you think?
Sure. Well, one of the things I learned on the retail side is that your quality of tenant and your tenant base is really your asset. And in this business, it's not the buildings, although the buildings need to look good to attract the right renters and the right quality of tenant. It's really your tenant base. So every time I forget about that, I'm reminded with it on performance of a property, especially when something unforeseen happens, like this pandemic has happened, where when we go back and analyze our portfolio and our different properties and which ones are performing better, we tend to see the ones at the lower rents struggling more, where we've got more restaurant workers and things that have been specifically really affected by this particular pandemic and shutdowns and restrictions that have been in place. So it's funny. We'll have some properties that look like nothing happened when you look at it financially and occupancy and everything wise. And we've got a few that have been really affected.
Have you noticed that there was an even more significant uptick in delinquencies, shortly after, I guess it was July 28th, whenever those boosted unemployment benefits ran out? Did you notice anything shortly thereafter, or
we didn't right away?
Okay. Yeah, we didn't either. It took about September was probably the first month where we noticed a very noticeable difference of uptick in delinquencies.
Yeah, ours was kind of October, and then November was a little worse, and we're kind of expecting December to be a little worse as well.
Yeah. Okay. What have you guys done outside of just, communicating and working out, payment plans, what have you? Is that have you done anything else outside of that you deem to be out of the box and just, going the extra mile to help out residents?
Sure. I mean, well, we've sought out different opportunities for support for those tenants where we've been able to find them. And then we've really been trying to be proactive with those tenants on, here's a resource that can help you with this. Here's a resource that can help you with this. And I think that's gone a long way with our tenant base and and helping to mitigate some of the challenges with collections right now.
Yeah, good deal. I'd love to switch gears a little bit if we could. And, everyone, it seems like every podcast, even mine, I'm not going to throw everyone else under the bus. Everyone talks about all the good about real estate investing and all the money you can make and how easy it is to raise money and all the good deals. But no one ever talks about the bad deals and the big challenges and the gray hairs that we get. I've got definitely to have this many gray hairs 5 years ago when we last talked. So maybe you can pick, one deal that comes to mind, and I like to call it the most challenging deal. And whether it was a deal that you ended up doing or you didn't do for whatever reason, maybe it was a deal you lost money on, maybe it was something you had partnership issues in, what have you. But what's that one that just really sticks out? I feel like everyone's got one, and it doesn't have to be a multifamily deal. But what's that one that sticks out that just was the biggest pain in the ass? And maybe go into some detail what were those challenges were.
Yeah, there's definitely one that stands out to me. It's a property that we bought. We bought it right. So we bought it at the right pricing and things. What we didn't understand was some of the challenges of the mechanical systems on the property. So this one happened to be a boiler chiller property. I don't know if you had any of those. It was our first one. It had a new boiler on the property, and the chiller itself was in really good shape. The things that we didn't understand with that system is how it circulates the water, and how even if the boiler and chiller itself are in good shape, the lines inside the walls and things are the problem. And then just things you learn from experience on that same property, because it was a boiler chiller system, it didn't have necessarily the higher energy levels running to the property and the amperage that you would have on a more modern property. And so you couldn't just replace we thought we were going to come in and replace the heating and cooling system with these other systems that are much more efficient. Found out that there wasn't enough electricity running to the building, and we couldn't upgrade it. And all these, it was just challenge after challenge after challenge. Part of that comes with experience. Part of it gets into not quite understanding what you don't know when you're doing a deal.
Yeah. So how'd that deal turn out? Do you own it today, or did you get out of it?
It's actually under contract. It's supposed to close in the next week.
Right,
so
knock on wood.
Knock on, knock on wood. It's turned into a great property, but it took 18 months to really get it fixed and turned around.
What did you end up doing? What was the solution to the heating and cooling issue? Did you have to replumb the entire thing?
We put in new gas lines on the roof. We put in new water lines. We basically had to take the property almost to 0% occupancy, get it, take out line. We're breaking holes in drywall.
That's a very intrusive project.
Yes, it's not an easy project. So at the end of the day, it was more just determination, and we're going to do this. We hired some really good people that understood the systems really well, and we were able to do it internally because we at that point couldn't afford to do it externally with some of the bids we were getting.
Man, I've got so many questions.
It was a challenge.
You took it to zero occupancy. How large of a property was it?
It was only 65 units, but I swear it feels like it was like 200.
That's a lot. That's a lot. I'm assuming you didn't have
challenges as we
did. You not have debt on it? I guess.
No, we did. We did.
You did. How'd that work out with your lender, knowing that
we had a construction budget with it, so we were expecting some negative cash flow. What we weren't expecting was the amount.
How'd that conversation? That lender had to be very understanding that you were about to take this to almost zero occupancy. That's a huge risk for them.
We had to cover a lot of the negative cash flow. We had to, so it was a cash flow drain for a while. it was, it was one that definitely, if I would have had hair at that point, it would have all fallen out. It was a stressful project.
So beginning to end, from when acquisition till you what you deemed it to be stabilized. So you did the repairs, you got it leased back up. What are we talking? 4 years?
2.5. We did it in 2.5. Actually,
that's quick. Yeah.
But it was a challenge the whole time, though.
What would you have done differently? I mean, would it have been as easy as having a HVAC contractor come in and actually do a thorough inspection of that system?
Well, we had them come do an inspection. That wasn't the problem. So the equipment that you could see was in great shape. The boiler was brand new. What you can't see on those inspections, though, is what's inside the walls. And what happens is when they run on pressure running through the lines all the time. And if any weak spot breaks, all of a sudden you've got a flood in that area. And so as more people come into the building or you start to lease it up, that's when it starts putting more pressure on the system. So it can be working great with, say, 30% occupancy or 40% occupancy, 50.
Okay.
And then all of a sudden you hit 60% occupancy and things hit the...
So you guys, you bought the property and it had some vacancies in it, so it wasn't fully under load. Okay.
Right. And so what I would say is just that when you're getting started or you're new to the building business, one, take on mechanical systems that you understand. Two, I would take on much less risk. So I would take straight down the middle type of projects to start until you really understand the business and the mechanical side of it and just the operations, the entire business. Just take on easy projects first. Don't try to hit just a grand slam. Hit some singles and doubles and get to know it before you take on something with that risk level.
Yeah, no, absolutely. Okay, well, that's a big one. That's a big one.
It was a challenging project.
Okay, yeah, that's how we all have them. That's how we learn, right? I mean, to think that you're going to go through your investing career and not have a property like that, it's just it's inevitable. And so if you're listening to this and that actually stresses you out, even thinking about getting into that situation where you literally got millions of dollars borrowed against the property, you got bankers you got to deal with, you got investors you raised capital from, you made projections, you're very far from those projections now because you've got to basically eliminate all the tenants in the property, go through a very expensive renovation process that you were not budgeting for, might even have to do a capital call. I mean, like, there's all these variables here and lots of stressful conversations that have to take place. And this shit happens. It just it's inevitable, whether it's your first deal, your 100th deal, things like this will occur. Maybe not this exact situation, but these challenging,
there's always
unforeseen, there's skeletons in every closet. Some are just piled up with more skeletons than others, and some of the skeletons are bigger than others, right?
Yeah, so. I always tell people you pick somebody to invest with not based on the best case scenario. You pick them based on what are they going to do if something goes wrong.
Yes.
Because there's always something that goes wrong. But one thing I tell every one of our investors is, so this is our pro forma. This is what we think is a realistic scenario for this property. But I can guarantee you it won't go exactly like this. Might be a little better, might be worse, but it will not be exactly like this.
That's it. Sometimes you hit it out of the park, you're like, wow, I set expectations really low and this one crushed it. And other times you're like, oh, this is a dog, darn it. It's not that bad, but shoo, this, that, and the other. And, now we're off track here a little bit. But anyway, that's a good story. I'm glad to hear that you guys are almost at the tail end of that one. So
and our people are still going to make money after all that, which is
that's great,
unbelievable.
Yeah, that's great. That's great. So this is kind of along the same line of that question is, there's been many deals. Again, if you are in this business and you own and you've built a portfolio, more than likely you've the properties that you actually bought, there were probably many more that you walked away from. Maybe not many more that you actually got as far as tying them up and then walking away, but there's still plenty that got tied up. And ultimately you found something during the inspections or something just didn't add up and you decided to pass on that deal. Is there one of those that come to mind that, that you actually made it into due diligence and for whatever reason, red flags came up and you decided to move on and walk away?
Yeah, there's one that I remember when we were probably our third or fourth year in business doing multifamily, and we were doing due diligence on it. It was a little over 100 units, and we could not find on the financials. They had like a missing $100,000 on the income side, that we, no matter how many questions we asked, the answers just kept getting more bizarre, which led just into a whole lot of other things that we found on the physical side, when we inspected that property. And so at the end of the day, it was one that we couldn't come together after doing our due diligence on. And it's just, you have to do good due diligence when you're doing projects, and it's up to you, especially if you're bringing other people's capital into the project. You need to treat it like your own, and it's your responsibility to do strong due diligence. And most buyers are great, or most sellers are great, but occasionally you get some interesting situations that you run into.
Yep. I using your example, I'd say, like, if it looks like a duck, walks like a duck, and quacks like a duck, it's probably a duck. And so obviously there was something not adding up, and no matter how many questions he asked, you couldn't arrive at an answer that just felt right to your gut, right? Something was still off. And so in those situations,
it's never worth doing a bad deal.
No, that's it. And what I found in those situations, I mean, well, not just those situations, any situation where your gut's actually talking to you, 99% of the time it's right, even though you think in your brain's telling you one thing, your gut's telling you the other. And just trust your gut most of the time. It's going to steer you in the right direction. And there's always the next deal. You know what I mean? Like it's never never look back and say, oh, I wish I would have, right? I mean, just move on mentally, write it off, move on to the next, because there will be another opportunity coming down the road that ultimately you might not have seen or heard of if you would have done that deal. And this next one could be even better. So.
And there's some that we've missed out on that have turned out really great, and there's others that we've missed out on that haven't done very well at all. So there's always another deal, and it's never worth doing a bad deal.
Yep, I agree. Well, now we're into to the end of the show here, Spencer. You've shared a lot of great information with us today, but I'd love to ask you, if you had just one final gold nugget of advice or wisdom that you could leave our listeners with here today that might inspire and motivate them as they progress in their own real estate investing career, what would that one last gold nugget be?
I mean, I think the most important thing when we were getting started is we really became a student of the industry. Mm-hmm. So really, really learn the business from the ground up. So I wanted to know what the maintenance people's jobs were, how these properties intertwine, how all the different roles intertwined in the business, and how the numbers all work. So really becoming a student of the industry and learning as much as you can when you're starting out, and continuing to learn as you go.
If you hadn't grown up in so you grew up somewhat in the construction industry, so that definitely was very helpful. But if you were starting over again and just happened to have a different upbringing to where you didn't have a family business that was in construction, you weren't around it all the time, what do you think you would have done differently? I'm more so looking for, like, what advice would you give someone that's kind of doesn't have that background, they don't have that family background, they're starting fresh? Like, what would be the best path to becoming a student of the industry to learn as much as possible in the shortest amount of time possible?
And I've thought about this question before. I think one of the things I wish I would have done right out of college is gone to work for one of the really big property management companies. Mm-hmm. Being a property manager or a leasing agent, and just really learning their systems and how they do things on the operations side. I think in multifamily, more than any other type of real estate business, the operations is where you make the money. So you've got to be strong at the operations side.
Yep. Yeah, you can buy a great deal, but if you don't operate it right, you're gonna be sinking. Mm-hmm. So, well, Spencer, this has been a lot of fun. Really appreciate you coming back on here. It's been great catching up with you. For those that want to learn more about you and what you got going on, where's the best place to find you?
Sure. You can find us on our website at apartmentinvestors.com. And we're happy to answer questions and help any way we can.
All righty. Good deal. Spencer, thanks again for joining us. It's been a lot of fun having you here.
Thank you.
Well, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Buff, wishing you huge success. You take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. We'll see you next Monday morning.